In 1999, everyone was buying tech stocks. You were telling clients to sell. What did it feel like to be right when the whole world thought you were wrong?
It's not something that you rejoice about and say, well, I was more clever than the rest, but we're really genuinely trying to help our clients. Even the world's greatest wine critics are swayed by a label. They see Mouton de Rothschild or Chateau Neuf de Pape, classic French wines. They say, oh, it must be a good year. But it may not be, but they love the label.
Passion is just not enough. It needs to be backed with the skill and practice. It's not never a straight line from point A to point B. I love to say it that way.
The FTSE was down 10%, but he had only lost 8%. So on a relative basis, he had outperformed the market by 2%. He said, well, that's impossible because the market was down 10. And I said, well, that's our source code. That's what it's been doing for nearly 20 years.
Big dreams don't come quietly.
They demand risk.
They demand fire. They demand transformation. Welcome to The Corporate Life, Billion-Dollar Conversations. Hosted by Hina Siddiqui, CEO and founder of Corporate Influence Media, creator of Capital Stage Credibility Positioning, 4-time Global Award winner, featured across more than 700 global outlets, and heard in 94 countries. Join us as we sit with tech CEOs, multi-million-dollar entrepreneurs, and leading investors, the people building what's next. Here, success isn't a headline. It's a human story. The turning points, reinventions, failures, breakthroughs, and bold decisions that change everything. Because every life is a movie, and you're the star of yours.
Alex, in 1999, everyone was buying tech stocks. You were telling clients to sell. What did it feel like to be right when the whole world thought you were wrong?
It's not something that you rejoice about and say, well, I was more clever than the rest. But, we were telling clients to be very, very careful because the markets were too high and it was in bubble territory. And we're really genuinely trying to help our clients to save their money and protect their portfolios. But unfortunately, in our industry, you do have a lot of egos and a lot of portfolio managers or equity research analysts naturally feel that they know best. And we've always said about our research is that we like clients to use it as a sanity check to their own fundamental research, because ours is a quantitative free cash flow model. And a lot of clients still like the fundamental 30-page glossy report on a stock. And that gets into the emotion, which we cut out completely. So it was difficult. And also with our system, over the years, we've learned that we're often 3 to 6 months ahead of the market. So to tell people that the market's too high and it's going to turn is difficult when it's shooting up, because the euphoria is there and everybody's piling in and fear of missing out. And it's difficult. So when people don't listen and get it right, we're upset, really. We feel that we tried,
Yeah. In fact, I guess people get too emotional with their investments. Like they invest emotionally a lot of times. Is that true?
Yes, that's absolutely true. You've hit the nail on the head there, because there is so much emotion in the markets, fear and greed, fear of missing out, as I mentioned. Everybody's buying and suddenly it's all panic, everybody's selling. But the markets are moving political rhetoric and geopolitical shenanigans. And all this is emotion and the fear and greed. But none of that has anything to do with the underlying fundamental analysis, unemotional analysis of the stocks or the sectors or the markets as a whole, where they are. But people make this mistake over and over again.
Yeah.
And we always about the emotion with analysts, we always say that even the world's greatest wine critics are swayed by a label.
Yeah.
They see a big they see Mouton de Rothschild or Chateau Neuf de Pape, classic French wines, they'll say, oh, it must be a good year. But it may not
Mhm.
be, but they love the
Yeah,
label.
correct. That's very true. That's a wonderful way at looking at it. That like when you take the emotion out of a decision, the decision tends to be much better than with emotion.
Yes, the source code we have is completely unemotional. It all it does, it focuses on the audited financials that are
Yeah.
produced by the company twice a year with their interims and finals, and we sort of re-engineer those financials, and we dig down deep into the balance sheet of the company, so we see the real health of a company. It's great to see, say, a company whose earnings are increasing, say, 10% on average per annum for 10 years. So 100% increase over 10 years. But if the debt has increased 500% over that same period, something's not right. And we spot that all the time.
Yeah.
But a lot of analysts purely just look at PE ratios, price to earnings. But if the balance sheet's not strong, then there are problems. And we identified that a few years back in the food retail sector. And one particular company I'm thinking about when I talked about those numbers, their debt had increased nearly 500% over 10 years, where the earnings had only increased 100%. So we were telling clients and other analysts that there's only two things that can happen. They either have to cut the dividend, which the directors would probably never do, or
Yeah.
have a rights issue. So, of course, most said that we were talking nonsense. And
Mm.
within 6 months, they announced a $2 billion rights issue.
Yeah.
I could give you loads and loads of examples over the
Yeah.
last few decades, but but
So yes, we will come to that. And for now, like I'm interested in knowing your story because you built a proprietary stock picking algorithm in the late 1980s, released it in 1998, and called the dot com bubbles correctly. Have been running it for clients ever since with a 76.2 hit rate. Now building it into a hedge fund, and you are also looking for seed capital. Just tell us about the whole story.
yes, the my colleague who wrote the source code in the mid to late 80s, who I can only describe as the mad professor, and he's a mathematician, but wasn't connected with the stock markets. He hadn't come from that background. So he wrote the code and he tested it for 10 years and enhanced it, obviously. And then he decided to launch it to the markets, to the stock market in 1998, and did a joint venture with a local stockbroker who had all the contacts with the pension fund clients and so on. Through the stockbroker, they were promoting or marketing the research. But very, very quickly, within a few months, we captured our first tier one pension fund client, which was quite a coup. But not only that, the client wanted exclusivity on our research because I think they could see that the edge that we had. And so we agreed, obviously, because it was our first client. But then after a year, we wanted increased subscriptions, but the client refused to pay more, but they released us from the exclusivity, although they remained a client. And
Okay.
almost immediately, we captured 3 or 4 more tier one pension fund clients. And even recently, I met the trader who was working at the stockbroking firm at the time when we were launching the research. And I didn't realize until a few months ago when I chance meeting, and he said, you wouldn't believe how busy we were. The trades and the orders and the business that was flowing in as a result of your research was just crazy. He said, we didn't
Yeah.
have any time to think. So that was something I never realized. But so that's how it started. And of course, we launched at the time of the dot-com bubble, rise, and then we identified it. But some listened, and the arrogant ones maybe didn't, and the humble ones, considered it.
Yeah.
But so that's how it started, and then over the years, we've been providing research to hedge funds and tier one pension fund clients.
This is interesting. And what made you start all that in 1980? What was the motivation?
Well, my colleague started it, and I hadn't met him at this stage, because I met the team fortuitously around in the late 2000s. But he was just he was just fascinated with it. It's a passion for him, and he was fascinated with numbers, and he just, I'm not quite sure what was the real kicker to start him doing it, but I know that it's 7 days a week for him. There's only two things that he knows about really in life, is that his source code and his favorite football team.
Okay.
And he analyzes his football team like he analyzes a listed stock on the stock exchange. It's really quite funny, but that's his life, 7 days a week, much to his wife's annoyance, long-suffering wife. But it's a passion, and I think that's what it's all about for me as well. Even when I started in the stock market, every single day is different, and the fundamentals are the same, obviously, but it doesn't matter how difficult it is to get up in the morning and commute to the office or whatever. That every day is going to be something different, and it's exciting. And I'm just lucky that I'm doing something that I really, really love.
Yeah. Yeah. So 99.9% perfect after 30 years. This is the journey of refinement. How does it look like? How does it feel like? And what breaks a model, and how do you fix it?
Well, the 99.9% that we believe the source code is that much perfect now, or as perfect as it will ever be. But that's taken years. It's cool because we were, even the global financial crisis in 2008, we were warning clients in December 2007 and early 2008 that the markets were too high. And again, we were probably 3 to 6 months ahead. Well, we were 3 to 6 months ahead, but we can see the trends. Sorry, I lost my thread a bit there, but over the years, it's been proven over and over again. When I met the team, I'm jumping forward a little bit now, but when I met the team, I said, well, why? Because they've got raw data, which they captured over the decades. And yes, the enhancements that have been made, small tweaks, not major enhancements. That all happened in the 80s, but small tweaks over the decades. It's just proven itself time and time again. And when I met them, I said, well, why aren't you running your own money? Why aren't you running your own fund? Because they have the raw data and they know how much the clients have made from their trading alerts or trading ideas. And the answer was, from the professor, is that, well, we're too busy doing our research, but if you want to launch the fund, be our guest. So that's what put me on the journey.
Yeah, it's interesting. And it makes you feel that accomplishment, like sense of accomplishment, that, okay, you are doing it with perfection because you are passionate about it. And I think passion is just not enough. It needs to be backed with the skill and practice and lots of it's a roller coaster ride, right? It's not never a straight line from point A to point B. I love to say it that way. Like there's lots of different twists and turns in the way that we have to survive before we reach that point of perfection.
Yes, I mean you have to fall over, don't you, and trip up a few times, and every time you trip up, you get stronger and stronger. And I always heard that classic quote on a lady on Bloomberg once. She says, failure is not the opposite of success. It's a stepping stone to success. But over the years, I mean, my foundation years were in trading, market making, proprietary market making with Warburg's, SG Warburg's in London and New York, and with Lehman Brothers also in London and New York. So that gave me the foundation. But then when I joined the asset management side of the industry, that was another whole area. And that's really what sowed the seed in me that I needed to have my own asset management business, because I could see how these large multi-billion-dollar funds were run. The client is just a number, a faceless entity, a number. And I really want to be able to have a business where the client can speak to me, one-on-one, and express their concerns, and we can talk through it. And so that's working in the asset management, with a large corporation. That's where I first knew that I needed to move forward with my vision.
Yeah, and it's a big responsibility, like taking care of assets and managing them for people, giving people the financial advice, which is actually one of the most important things for people, like, finance, money, and all that. So it's a big responsibility too. Did you ever feel fear, like, okay, I mean, what if I am guiding it the right way, or something like that?
Yes, to maybe a little bit in the beginning, but I think my grounding or foundation years of proprietary trading, it taught me to stay calm under stress, under pressure. The markets are moving around fast, and fast markets, and you have to stay calm, because if you don't, you make a mistake. And I think that gave me the grounding for when you're now responsible for clients' legacy. Really, you're responsible for their retirement and maybe their children's legacy, after that. But I think just over the decades, I've learned to stay calm and
Yeah. So the best practices, as we were talking before that, take the emotion out of it.
yeah, because my clients get emotional. I mean,
Yeah.
they see the markets flying around all over the place, and I've got to try and tell them, well, look, it's just a short-term blip.
Yeah.
Don't panic. So they need to be reassured. But I've seen enough over the years that I think I'm not 100% right, obviously, but if I can, as you mentioned, if our code can get it right just over 70% of the time, then we're on a win.
That's interesting. Yeah. Alex, you're raising a hedge fund now. So why now, and what's the vision?
Well, yes, I touched on the vision a bit just now, with really wanting to have a firm whereby you see that a lot of the industry now has indexed a lot of funds. A lot of big funds are indexed or passive funds, and a lot of the family office or ultra high net worth events that I've attended over the last 2 years in London, the common theme that comes through is that the younger generation in the family offices, so the succession that are coming through and taking up the reins, they are complaining that their fund managers are not taking enough risk.
Okay.
They're younger, they've got a higher attitude towards risk, or a better attitude towards risk, and tolerance, should I say. So, but a lot of the fund managers are not prepared to, because there's so much volatility nowadays, and they don't get you very rarely get congratulated for making money, but you get absolutely lambasted for losing it.
It's a thankless job.
Because making it is what you're supposed to be doing.
Okay.
So there is a very, very big call globally for emerging active fund managers that have an edge. And not everybody's got that edge. To find the source code that I found was really, really lucky. I met these teams, because a lot of portfolio managers are, well, to quote from Wall Street, they're throwing darts at a board a lot of the time, and just hoping that 50%, more than 50% of the darts actually hit the target. So, but I had a meeting. Really, what made me decide I finally got to do it is I had a meeting with an asset manager in London, and this is just before COVID. And I was asking how his FTSE 100 fund had performed. And the year before, the FTSE was down 10%, but he had only lost 8%.
Okay.
So on a relative basis, he had outperformed the market by 2%. But the fact is, you tell me a client that's happy that their fund manager has lost 8% instead of 10. I mean, it's crazy, but that's how the markets are. So, and he said, well, how did your source code do in that year? And I said, well, we made a profit of 14%. So he said, well, that's impossible because the market was down 10. And I said, well, that's our source code. That's what it's been doing for nearly 20 years. And so that was the end of the meeting. And I pretty much had the sort of epiphany as I walked out of that office. I said, right, that's it. I have to start. So that set me on the journey. And I did actually launch a fund just before COVID.
Okay.
But then COVID struck, and it meant that I wasn't able to walk the streets and shake hands and look people in the eye, which investors want. I was pretty much locked down for 2 years. So, the small investors I managed to capture initially, I had to give the money back because the running costs were outweighing, the fees earned. So now I'm reinventing again.
Yeah, this is very interesting. And I'm sure that with your kind of expertise, it's going to be a successful venture.
We think so. Quietly confident, because over the years we know how much money our clients have made through using our research, because we've got the raw data. So we know the system works. We know the source code is accurate, and we know the hit rate, which has been provided to us by independent sources. So we're confident that we will do well. But of course, now I've just got to embark on finding the new investors again.
Alex, you have been such an expert in this industry, so I would like to ask you this question that most tech founders think hedge funds are only for public companies or late stage players. What they don't understand about how hedge funds actually work, and where is the opportunity they are missing?
They're not that much different to the long only pension funds. The main difference is the agility. A hedge fund is able to react on specific movements in the market or what they see might happen. Whereas a pension fund, obviously they're managing billions or trillions of pension money, so they are not able to take the risk. The authorities around the world, wherever the pension fund is, will say that they can't take the risk. So they pretty much buy stocks and hold forever. But by having it umbrellaed into a hedge fund, it allows our source code to really work, because we know that maybe the markets are oversold or overbought or whatever, maybe sectors or individual stocks. So we're able to act on that. What we've over the years, we've advised pension fund clients that are not able to trade in and out because that would be deemed as churning, and that's risk which they're not allowed to take. But what we say is, your holdings don't go up in a straight line forever. They do have pullbacks. So when we can spot when the pullbacks are coming, not 100% of the time, but most of the time, and we advise the clients, say, well, sell 20 or 30% of your holding, and and wait for it to come back 10 or 15% or more, and then buy it back. So to enhance your returns long term. So the hedge fund, I suppose it's really more for sophisticated or professional clients, because it's difficult for a hedge fund to take in small amounts of money, $5,000 or
Yeah,
10,000, because it's an administrative nightmare.
true.
So the hedge fund is really targeting clients with a minimum of, say, $250,000 or $500,000 to invest. And also, they have to be patient. They have to know that it's a minimum of a 5-year term that we need to enhance their returns.
Yeah, that's a valuable advice.
Get ready for the ultimate challenge, this or that. Choose fast, trust your instincts, and let's go.
Now let's make some fun and just play a game which is called this or that. And I love to play this game with every guest on this show. It's like I will give you two choices. You just need to pick one instinctively, no overthinking. And this will help us know you better as a personality. So are you ready?
I'm ready, as I'll ever be.
Okay, so your first question, emotion or algorithm, which wins long term?
Well, algorithm.
Called the dot-com bubble, best day or most terrifying?
Well, terrifying.
Active management or passive indexing?
Active management, without thinking.
30 years of data or 30 years of instinct?
Both, but I'd have to choose data.
Jim Simons or Warren Buffett?
Jim Simons, because our source code is just like his.
Okay. Build in public or build in private?
Private.
Seed capital or bootstrap to profitability?
Seed capital.
The trade that made you or the one that taught you?
The one that taught me.
Well played. Thank you. It was quick and fast. Alex, we believe that every life is a movie and you are the star of yours. And seeing your life story, it's definitely a blockbuster movie. So, what is the title of that?
Early one morning.
And why is that?
Because I find I gain my best inspiration when I'm up as the sun rises and the birds are chirping and it's quiet and still, well, except for of the birds, of course, but and you're able to think clearly, and another day is dawning, and it's an inspirational time of the day for me. So early one morning, and
Yeah.
Also I can remember the exact time when I decided, right, I need to start my own business, and I was actually doing my early morning run. And while I was running, I realized, no, this is it. So that's the title.
The early morning, you remember that the day, exact time when you started your business. So what was exactly that time?
I can't remember the exact date.
Okay.
But I remember the year and
Okay.
the time. Yeah. It was, I was in Africa at the time. So the Southern Hemisphere. So it was spring, which is in September, and we've just been through, a hard, cold winter. So spring arrives in South Africa. It's effectively spring and summer all together,
Yeah.
It's just winter one day, next day it's spring and summer. And it was a spring morning in September that I was running, and the sun was rising, and I knew that this is my focus. This is what I need to do.
for those who would like to follow the rest of your movie, how can they do that?
Well, I'm not big on social media, unfortunately, but I think I'm being dragged kicking and screaming by my daughter and my son into social media. So LinkedIn will be where I will be enhancing my profile, and I will be updating with developments. Currently, we're going through a major back-end IT programming upgrade to the source code, so ready for the next chapter. But through LinkedIn, I will be. What I want to do actually is give indications of how the source code works. Obviously, not the real secret source, but I will be posting on LinkedIn as to the investment methodology, why we think it works, and what we've shown over the years. So LinkedIn will be the best place to watch me.
Right.
I also will be in the middle of creating an updated website. So that will be there as well.
Right. And as you are creating your, raising your hedge fund, would you like to tell us how can we support you, in what ways?
Yes. Obviously, it's raising either assets under management, so investors into the fund, or a pre-seed, bringing an investor who can take a shareholding in the business as we relaunch. So that those are the areas. But we've got so much that we want to do, because the source code can load any stock in any country around the globe, and we've done a lot of ad hoc valuations for pension fund clients over the years. So once the upgrade is completed, we'll load, say, the S&P 500 stocks, and then we'll load the German market or the French market or any market around the world, and then we'll create a new fund once that universe has been loaded. So for an investor, the strength of the code is that we can build the offering to tens of thousands of stocks. So it becomes a very valuable intellectual property.
Right. Thank you for your time. I really enjoyed talking today with you and also learned from you. So thank you, and all the best for the fund that you are creating.
That's wonderful. Many thanks. I was pleased to participate. Thank you.
This is The Corporate Life. More stories, more insight, more truth. Until the next episode, stay curious. Don't forget to subscribe.